Upstart Holdings is an interesting AI company that I think more investors will start focusing on as the Federal Reserve in the United States starts cutting interest rates. So I will be providing more coverage on this company as I have been in recent days. In this video, I'll dig a little deeper on what the management team said and what investors need to know about the company's most recently completed quarter.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the company's CEO talked about how the funding markets continue to improve as the year progresses, particularly since the Liberation Day fears in early April subsided. And I've been surprised about these prospects over the previous 2 years, actually, since the start of 2024. Many investors and many lenders, including companies like Upstart and SoFi, indicated that they expected the U.S. economy to slow down significantly. Those slowdowns or those fears of a slowdown never materialized in 2024, and the year turned out to be much better than expected macroeconomically. 2025 has been a little bit different in that the economy is slowing down now. In recent months, the number of jobs added to the economy have slowed, and the number of job openings have slowed considerably. But they're not as bad as was feared when the United States and President Donald Trump announced tariffs and increasing trade barriers against all trade partners. There was a huge slowdown in economic activity in the immediate aftermath of those announced tariffs. Since then, economic activity has recovered and returned to, I don't want to say normal levels, but levels that were much better than was feared. In June, the company priced and closed their second ABS deal as of 2025, delivering significantly improved execution compared to their first, which closed in April. It's worth noting that more recent transaction had nearly twice the number of investors as the first, including some new lenders. And I've seen similar results from SoFi, in that lenders are becoming more and more interested in participating in these markets. They want to fund these loans that are originated by companies like Upstart and SoFi because they like the rates of return. They like that lending with these companies, they can earn rates of return of 10, 15, or upwards of 20% if they go into the riskiest parts of these markets, which are personal loans. They can get a 20% return on investment. Of course, there's going to be defaults on some of the loans they make, thereby decreasing the return on investment. But overall, they like the attractiveness of these markets because of the rates of returns they're getting for lending this money. Remember, if lenders borrow, or if lenders, let's say they want to invest in bonds or debt, and they go into a U.S. government bond, let's say a 10-year U.S. government bond, they're going to get about 4.1% on that bond, whereas they can invest in loans originated by Upstart and SoFi and others and get upwards of 10, 12, 15, 18% rate of return. Of course, they're taking more risk by investing in loans originated here, held by consumers that are making payments. So if they lose their jobs, they're likely to default on their loans at a much higher rate. But lenders are okay with that because they're getting so much in return. They're willing to take that above average risk because they're getting a well above average rate of return on that investment. By the way, this document I'm reading from is Upstart's Q2 25 earnings call transcript with Wall Street Analyst. I made this highlighted document available for my channel members, and you can join my channel for less than $5 a month. I have dozens and dozens of these already uploaded, and I'm regularly uploading more as I go through these companies' conference calls. So the CEO says that looking over the last couple of years, we've done a lot of work to run our business more efficiently and streamline our cost structure. And this started in 2022, mid to late 2022, when inflation was soaring out of control. And when inflation is soaring out of control, the central bank usually increases interest rates. And when the central banks increase interest rates, it usually causes a huge decrease in economic activity when related to activity that's connected to borrowing anything longer term, because those interest rates, like for cars and for loans increase meaningfully. And when those monthly payments increase, you become less interested in borrowing to buy those items because the interest rates and your monthly payment is much higher. So this company, Upstart, and many others anticipated a huge decrease in economic activity and a potential recession. So they really tightened their belts. They cut costs, they stopped hiring, they let go of people in preparation for a potential slowdown. And so since then, they've had a more streamlined cost structure. And as this business has recovered, they haven't really, you know, hired aggressively because they've never felt like, oh, it's smooth sailing from here. There's been like consecutive risks that have concerned companies like Upstart, but they did have conviction that investing in much larger home and auto opportunities made sense, and these categories are less risky, less volatile. They come with more collateral. And so I like that they've invested in these categories, which I agree with the manager here saying that they're ripe for AI disruption because the process, especially for home loans, for borrowers, if you've ever gone through a home loan, you'll know how inconvenient, time consuming, and stressful it can be. So I agree, they are ripe for innovation and disruption, and they've expanded Upstart's total addressable market opportunity by more than 10x, while also decreasing the downside because the business is less risky if it's more concentrated in auto loans and home loans because these loans come with more collateral. And so these are some of the reasons why I recently upgraded Upstart stock to a buy. I've never had this stock rated as a buy until today. For over 5 years, I've been following this company. I never felt the situation was quite right for long-term investors. I've always liked the upside of the business, but I never felt the price made sense given the risk versus reward. That is until today, where I feel now the upside and the current market price makes sense for long-term investors to take a chance. This should only be for investors that are willing to tolerate above average risk, because this is a very well above average risk company, but you're also getting a huge upside opportunity with Upstart, which is addressing a massive market opportunity with an innovative lending model. If proves to be successful, could deliver huge upside for long-term investors. So that's why I say it's only for investors willing to tolerate high risk, looking for above average rewards.
Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.